Good afternoon, ladies and gentlemen. Welcome back to the last weekly market review for February. Chinese New Year has ended, so we should stop our bak kwa and steamboat binging for now and put our attention back to the market. Today, as usual, I have with me my co-host here, Mr. Gerald Wong. Gerald, how are you over the weekend?
Okay, so managed to get some rest after two very busy weekends with the Lunar New Year. But like you said, the markets have actually been very active over the past few weeks. So quite a number of things that we're going to be sharing with the audience today as well.
Yes, I remember last week we have some big company earnings like from UOB, from Singtel, from SIA, and I think we also cannot miss the monster blockbuster earnings results of Nvidia. So will you be taking through some of the details of these stocks today?
Yes, exactly. So I'll be going through UOB, SIA, Nvidia, since they are very widely talked about topics over the past week. But before we start, just a usual disclaimer that today's session is for information purposes only and should not be taken to be financial advice. If you find the session helpful, do leave us a review on Google. And you can also consider joining SIAS as a member to be able to participate in different events, including our monthly Ask SIAS session. Okay, so what we saw in the past week would be the continued gains in the US market. We see the S&P 500 now close to the 5,100 level, with the gains continue to be led by some of the tech stocks. So like Sunny mentioned earlier, we had Nvidia results last week, and that actually provided the boost towards the entire US market. In Singapore, the STI has been weak. While some of the results reported by the US companies have been fairly strong, we saw some disappointment coming through in the Singapore listed companies. So that effectively explained the weakness in the STI. And I'll be going through two of these names later, which is UOB as well as SIA. Okay, just on the macro front, no major releases in the past week, but just a trend that I wanted to point out in that we have started to see US government bond yields starting to bounce back again. So if you look at the US 10-year Treasury yield, now actually much higher than where it was at the start of the month. And likewise, if I look at the US 2-year Treasury yield, this is the one that is most sensitive to what the Fed action is likely to be. It has climbed by an even larger amount. So while this has not actually led to any sell down in the market as yet, what we may see this being reflected in is that for some of the more yield sensitive products, say like your Singapore savings bond, your Treasury bill in Singapore, they might actually react to some of these movements in the higher US Treasury yields. Okay, so moving on to the Singapore market performance, we saw that there were losses in the past week in the STI. Within the top gainers, what is interesting is that there are a number of the consumer-related names. So Wilmar gained by 4.6%, Thai Beverage 4%, and DFI Retail Group with a 2% gain. So generally more defensive names compared to the other cyclical ones. Okay, so in terms of the worst performance, I think this is where the stocks here effectively tell us a different story. So we have got Genting Singapore down by 10.6%, SIA down by 10.5%, SETS down by 6.1%. So quite a number of the tourism-related stocks taking a hit at the back of the earnings reported by Genting as well as SIA. Okay. So even though there's more optimism about improvement in the tourist arrival numbers, some of you might be excited about, say, the Taylor Swift concert that's happening this weekend, but that is definitely not reflected in the share price of the tourism-related stocks. In fact, some of them saw massive losses in the past week. Okay, so I'll start with UOB since we went through DBS in the past week. UOB effectively had a strong gain after DBS results. because investors were expecting that they might actually have a good dividend for shareholders as well. But you see this correction after the announcement of their results. So you might be wondering what is driving this sell down in UOB stock. Okay, so if I were to look at the earnings, I think what is interesting to me is that the net interest income, if I compare the fourth quarter versus the third quarter, it was actually down about 1%. And if I compare that to the previous year, it was down about 6%. So the net interest income is actually coming off, okay? And if I look at the core net profit, in the fourth quarter, it was at about 1.5 billion. So this is just up about 1% compared to the previous quarter. And I think that might be something that disappointed investors who might be expecting more after the announcement of the DBS results. Okay, so earlier we saw that the net interest income is coming off. I think this is a chart that we need to pay attention to. So if you look at the net interest margin of UOB, it has been on a downward trend. So in the fourth quarter of 2022, it was at 2.22%. And by the time we're in the fourth quarter of 2023, it was at 2.02%. Okay, so the net interest margin has come off in consecutive quarters, and that might be something that is capping the upside in UOB's share price. Okay, if I were to look at the fee income, if you recall in the third quarter, we mentioned that the fee income for UOB was very strong. But in the fourth quarter, we started to see the fee income coming off slightly as well. So 569 million in the fourth quarter versus 591 million in the third quarter. Okay, what is dragging down this fee income is effectively coming through from the loan and trade related. So with the slower economic environment, they have not been able to get as much fees from this division. But if I was to look at the credit card segment, that continues to be fairly strong, and that is what is helping to support the fee income of UOB. Okay, so the company also provided the outlook into 2024, and from here we can get a sense around what their prospects are for the year ahead. What the company is expecting will be a low single-digit loan growth, double-digit fee growth. So the fee income is still something that they are fairly positive on, especially after the acquisition of Citi's business. Okay, so with that, they expect the total income to see positive growth. The core cost to income ratio at about 41 to 42%, and credit costs still remaining under control at the lower end of 25 to 30 basis points. Okay, so overall, slow loan growth, total income to be still positive growth, supported by the growth in the fee income. And also, if you look at the credit cost, they're not expecting it to spike significantly this year. Okay, I'm sure a lot of you are very interested in UOB's dividends. So in the second half of 2023, the dividend was 85 cents. So with that, it will bring the total dividend for 2023 to $1.70. Okay, so this is an increase compared to the previous year. But once again, maybe compared to what we saw for DBS, this may not actually be as high as what some investors might have been expecting. Okay, so regardless, if I were to look at the 170 dividend per share from a dividend yield perspective, that would bring UOB's dividend yield to close to 6%. So depending on whether this is something that appears attractive to you, then you can consider whether you want to be doing more work and understand UOB's prospects in the coming year. Okay, the next stock that is also commonly talked about, Singapore Airlines SIA. We saw this very strong run-up before the results, but then having a very significant correction, I think, on the day of the results of close to 9%. Okay, so what is driving this disappointment in SIA share price? If I were to look at the revenue for the fiscal year third quarter, which is the calendar year ending 31st December, actually what we see is that the revenue growth has still been fairly strong, but the expenditure actually came up sharply, and with that, the operating profit actually declined compared to the previous year. Okay, so we'll break down each of these drivers in more detail. We start by looking at the revenue. Okay, the revenue in the fiscal year third quarter is still very strong. They reported a record quarterly revenue of close to 5.1 billion. Okay, so this is really driven by the recovery in global travel that we see, and the passenger flown revenue has actually gone up fairly sharply compared to the previous year as well as the previous quarter. Of course, the calendar year ending December is also the calendar quarter ending December is also the stronger quarter from a seasonal perspective, because more of us are actually away for year-end holidays during the November to December period. Okay, what we see for the cargo business is that while there is also a slight seasonal pickup, okay, there's more e-commerce purchases in the quarter. But if you were to compare that to the previous year, where it was still benefiting from the post-pandemic bottlenecks, so what we see is that the load factor has actually come off fairly sharply, and that's also driving the slower profit that we see for SIA. Okay, so this is the part that we need to keep a lookout for. The group expenditure has increased as it is bringing more planes and flights back up again. If you look at the net fuel cost, it's actually gone up because of more flights being operated, and likewise, the non-fuel expenditure has gone up compared to the previous year as well. So it will have to hire more crew. It has actually got to pay more maintenance fees as more flights are being flown, and that is actually driving up the cost of SIA. Okay, so with the kind of revenue growth that we see, it was actually insufficient to offset the increase in the cost. So with that, the operating profit actually came down compared to the previous year. Okay, so 609 million in the fiscal year third quarter versus 800 million in the previous quarter and about 755 million in the previous year. Okay, so if you notice, this 609 million is also the weakest since the previous fiscal year, second quarter. Okay, so effectively, some of this post-pandemic recovery is starting to be eroded as the costs actually start to creep up. Okay, the good news is that currently investors are still expecting that SIA will be able to maintain their dividend per share this year at about 38 cents, which is unchanged compared to the previous year. So if I was to think of the dividend per share and divide that by the share price, what this translates to for SIA's dividend yield would actually be close to 5.8%. Okay, so that is SIA. What we need to keep a lookout for is whether the passenger load factor continues to come off, whether the cargo business will remain weak, and whether we'll see the continued increase in operating costs that will actually erode away the profitability. Okay, last but not least, I wanted to just briefly talk about Nvidia, since this is effectively the stock that many investors were keeping a lookout for in the past week. Okay, so even though you may not be an investor into Nvidia or into US tech stocks, it might just be helpful to get an understanding of the key drivers here, since it is actually moving the overall market over the past few weeks. Okay, so Nvidia has actually done very well, and even in 2024, we see a continued rally. There was a bit of a pullback before the results as investors were uncertain about whether they can already meet the very high expectations. But what they were able to do is still surprise positively, and that led to the further bounce in Nvidia's share price. Okay, so I think generally what we need to understand is the larger adoption of artificial intelligence, and this can be across many different facets. It can be through AI content creation, which is serving the 50 million creators globally. It can be in many different areas, such as in your search and social media. You might see some of this AI-assisted prompts that are coming up. And this effectively will provide the backdrop towards why there's more talk about artificial intelligence and this being a large addressable market amongst investors today. Okay, so this is effectively what Nvidia sees as the addressable market. They see that as a 1 trillion long-term market opportunity. And we are probably looking at the current phase being just at the starting point of this AI adoption. Okay, so far we have seen some of the users in gaming. We have seen some of the users in how they've been able to grow their data center revenue. But there is actually still a lot of different pockets of opportunity that Nvidia believes it can actually tap. Okay, so I wanted to talk a bit more about this data center revenue growth that Nvidia has been able to see, because that is effectively what is helping to support the revenue and profit at this point in time. So I think what is important to note is that some of these AI processes actually require a lot of computing power. So that comes to this point about data centers then becoming the AI factories, where data is the input and then intelligence as the output. Okay, so when you actually want to run a lot of these models, they actually require a lot of computing power to the scale of actually a data center. So it's no longer just talking about like a PC, but effectively you need the whole data center to come in to be able to support some of these large language models. Okay. So some of the graphic processing units that Nvidia produces are actually used in these data centers, and we see very strong demand for some of these GPUs. Okay, so this probably reflects the explosive growth that we see for Nvidia. So it's actually something that is supported by their revenue growth, especially over the past few quarters. Okay, so if you look at the revenue in the data center segment, previously it was at about 4 billion per quarter. But by the time you actually look at the most recent quarter, it's actually exploded to about 18 billion per quarter. Okay, so rarely do you see such explosive growth in the revenue, and definitely not within the span of 1 year. Okay, so as a result, we have seen this very sharp growth in the revenue for Nvidia in the most recent fiscal year. The operating income has grown as a result of that as well. And if you look at the breakdown, that is mainly driven by the data center revenue, where from being about 40% in FY21, it now represents about 78% in FY24. Okay, so that in a nutshell is what is driving this very strong interest in Nvidia, as well as the strong share price performance that we have seen. Just one point to take note is really around the valuation. What is noteworthy to me is that if I look at some of the valuation of the Magnificent Seven stocks, and that will include Nvidia and some other names like Meta, which have done very well, is that the P ratio as of the early part of this year is at about 35 times. And this P ratio would likely have grown since then with the continued strong share price performance. And if you look at what the valuations are for the S&P 500, also of the Magnificent Seven, then it's at about 15.5 times. Okay, so a lot of the growth in the S&P 500 is driven by the Magnificent Seven, and we have seen that the PE valuation of these stocks have also gone up significantly as well. Okay, so what to look out for in the week ahead? We are in the last week of the result season in Singapore. We saw Seatrium and Cromwell European REIT reporting their results today. And upcoming in the week ahead, we also have OCBC results. We have a number of different industrial stocks like SETS, ST Engineering, as well as ComfortDelGro results. If you're an investor in the bond market, we have the SSB application closing date today, as well as the Singapore 6-month T-bill auction that's coming up on Thursday. Okay, so with that, I'll hand over to Sunny, who will share with us what the technical indicators are telling us about the markets.
Hey, thanks, Gerald, for the sharing of some of the big earnings that we had last week. So definitely Nvidia is something that everyone is looking out for. But I just want to put some of my opinion in over here. A lot of the investment thesis or a lot of investors right now or the market as a whole are front loading into the tech stocks or even the chip makers. So definitely there is some risk over there. And if you want to chase the upside or if you want to chase the uptrend of Nvidia or even the Nasdaq Composite Index, right, you would be better off to look out for any chances of a pullback instead of jumping straight right in. And what I'm always looking out for is where the next pullback could be. So looking at macroeconomic data that's coming out for the rest of February, you do have the GDP data coming in on 28th Feb Wednesday, and that is going to be slightly lower than the previous reading. The consensus now is 3.3. So we hope that it will meet the consensus, although the GDP is coming down, slowing, but we are not looking at a market that's going into a recession. So this is one of the economic data that you want to watch out for to make sure that we are still on track so that the current rally can still persist. Then the next important one will come on 29th February, Thursday, which is the PCE price index, and that is also what the Fed is watching out for to see where the inflation is going. So the previous time we shared about the macroeconomic data, the PPI data, which was also a much hotter number than what was the market expecting. We are saying that it will flow into the consumer side, which will flow into the CPI, and you might also want to look out for the PCE as well because the consensus is also looking at a higher number from the previous reading. So all these are signs that inflation is not going to go away very soon. It might even make a comeback, and hence the interest rate is not likely to go down anytime soon. Maybe a very slight chance, a 0.001% chance that we might see a interest rate hike, or even we might not see any interest rate cut happening this year. So these are a few scenarios that you will need to pan out in managing your investment and portfolio. So next, let's move to the STI index. So last Monday, which was 19th of February, we said that the rally that was led by the DBS result, we are likely to hit the next resistance level at 3250, which was the high that we saw last December. So we went to that level close enough, but not really hitting 3250 at 3247, and then now we have a pullback. So now we have a double top formation on the STI index, which is going to be a very strong resistance going forward. And if you look at the support side, you also have a support at the low of 14th of February at around the 3,092 points level. Like I said earlier, we rounded off to the 3,100 points level, and this would be your first trade of this year on the STI index. Now, combining this support level with the one of the low that we see in December, before the rally started in December, you can see that it has also formed a double bottom kind of formation, which means that this level is likely going to be a very strong support level at the 3,100 point level. So I think in the midterm, looking forward to the June period, the half-year point of the STI index, we are likely going to be range bound. The top side is around the 3,250 level. The bottom side is around the 3,100 point level. And the current reading that we have at 3,158 this morning is likely is somewhere in the middle right now. So we are more or less at the pivot point. And the 200 days moving average that you see over here in red has already been broken down this morning already. So meaning the downtrend or the pullback has already restarted, and likely we are going to retest a 3,100 points support again for the STI index. And that now also coincides with the lower bound of that Bollinger Band at 3097. So I think most of the investors on the STI index after the major announcements would already have take some profit off the table, hence the pullback. And now we are waiting for the STI index to go back and reach a support level before we look at the indicators again to see whether they are in a oversold position and favorable for a rebound back upwards. So now, no projection as of now, but we are likely going to go back to the 3,100 points level. And as you can see over here, the candles here shows that there might be some bias coming into to support the market, but then this would still be very close to the mean or the average that we are looking at, and we will want to see a sort of a gap down or something like what we see on 14th February to let us have a chance to get back into the market with a margin of safety, a buffer, and hence target the 3250 level again on the STI index. Next, let's move to the Dow Jones Index. The Dow Jones Index, we have a new all-time high. We have a new all-time closing high, and that is last Friday, 39,131 points. So like what Gerald said, most of the rally led by Nvidia, one stock holding up the market. But then there's a lot of research report also saying that this rally led by Nvidia or the AI tech sector is actually spreading out to the rest of the semicon players as well. So you can look at AMD, you can look at Intel. So those are the second or third runner up, which you might want to get into if you have missed the Nvidia rally. Okay, so we have broke the previous high on 12th of February. We are at an all-time high now. So anything above there is no previous level that we can reference to. And now we are looking at the technical indicators. Definitely, if you look as a whole for this year, January and February period, the RSI is already starting to subside from the peak that we saw in December. What does this mean is that the rally is feeling a bit of exhaustion, and we may be close to the near-time peak, and a pullback could happen if some of the data were to miss. And when that happens, you'll be looking at the 20 days moving average, which is the black line that you see here, the Bollinger Band basis. If the data is good, okay, that's one scenario. If the data continues to be positive, then the uptrend will persist. Then the 20 days moving average, as you can see over here, this period resting on the 20 days moving average nicely, as well as this period over here in the January period. So the 20 days moving average would be the first pullback point, the first support point that you'll be looking at. If your thesis is the rally is going to continue, 20 days moving average could be a good reference point for you to get back into the rally that we see in the US market right now. However, if you think that the rally is going to take a pause, or we are going to be range bound here going forward towards the second half of the year as the interest rate situation is unclear, the inflation continue to stay very high or even starts to increase again, then you might want to look at the 50 days moving average, which is the blue line that you see here, and that's around the 37,779 points level. So for myself, I think my opinion would be the rally, the momentum that we see in the indicators, is actually starting to get weaker and weaker. The uptrend momentum is getting weaker and weaker. So I'll be a little bit more cautious. I would think that the 50 days moving average for me would be a better point to look at, because as of now, with the uptrend momentum getting weakened, I'm not sure if this rally is going to continue any further, and I don't have any reference points up above. So my option will be now, my investment thesis will be now, either market is going to stay elevated around this point level over here, the 40,000 level, and then after that we might be range bound in the 40,000 level, and hence if that range bound kind of pattern starts to happen towards the second half, then the 50 days moving average level would be more ideal to play a range bound kind of trading pattern going forward in the US indices. Okay, next, let's move to the S&P 500. Okay, so S&P 500 also broke the previous high on 12th of February. We are now at 5,088 points level. Just to put in a bit more details, we actually broke the 5,100 points level during intraday trading on Friday, and we reached a high of 5,111 points. But the thing is, we are unable to close above the 5,100 points, so thereby signaling to us that there's a bit of weakness there. There's a bit of profit taking over there. Sellers are starting to come in and lock in their profit, and hence we should look for a pullback before chasing the S&P 500 again. And of course, you'll see that the 20 days moving average would always be a good indication of a support level or a bounce back up should a pullback happen. And the 20 days moving average for the S&P 500 is at the 4,975 points level right now. Okay, indicator wise, MACD is, as you can see, is showing a negative sign already. We have a negative MACD reading, so that means negative momentum is starting to creep into the S&P 500. Of course, in the past few months, it has been crisscrossing up and below the signal line, so the reading can jump from positive to negative from week to week. But definitely, it is on the top side of things. And if the divergence between the MACD line and single line starts to happen, that is the key thing that you need to watch out for. RSI is at 68 point, testing the 70 point overbought mark. And we have also come down from the peak in December of around the 82 points. So you can say that in a very strong uptrend, right? Usually the RSI indicator would trend above the 50 point neutral mark towards the 70 point overbought level. So if you see the RSI pull back to the 50 point level in the RSI and you deem that the rally is going to continue, then that is where a good indication of support might come in on the S&P 500 should the RSI hit the 50 point neutral mark. And in an uptrend, if you want to wait for the indicators to go into a oversold kind of indication, is very difficult and most likely you will miss most of the rally. So I would say that as of now, the RSI reading at 68, closer to the overbought mark. Hence, I will not go in right now. Also at the upper bound of the Bollinger Band already. I will wait for a pullback closer to the 50 point neutral mark or towards the 20 days moving average at least before I relook at another entry to the S&P 500 index. Lastly, let's touch on the Nasdaq Composite Index, which is one of the biggest beneficiary of Nvidia rise or Nvidia's earnings results or Nvidia rally last week. So you can see that even though we have a gap up on Thursday on the Nvidia's result, Nvidia was up 16% on Thursday itself. And Friday, we can see that there are traders already locking in a profit, and hence you see a negative red candle on the Nasdaq Composite Index. So you can see Nasdaq is the only negative performer among the three major US indices. So if you look at the indicators, it's even more apparent that the downtrend, the RSI, which measures the momentum of the rise, is also starting to subside right now. So I think for the Nasdaq Composite Index, 20 days moving average, you can see it has always been, it's not really a good support level, but anytime it breaches below the 20 days moving average, it's a good time to look at the Nasdaq Composite Index. So similarly, I have been trading the Nasdaq Composite Index for some time on the TQQQ, the 3X Nasdaq Composite Index ETF, holding it for quite a long time, and sometimes I will buy some protection. As of now, this rally has, I would say, the rally has run quite a bit, and we are seeing a bit sign of an exhaustion coming in. So I'm not in a hurry to chase to add on to that Nasdaq Composite Index ETF position. I'm always waiting for a pullback to happen towards the 20 days moving average or the 50 days moving average before we consider adding on again. So Nasdaq Composite Index will be something that you need to watch closely to understand where the tech stock or the Magnificent Seven that Gerald mentioned is likely going to head going forward. So that is all I have for this week. Final words, Gerald?
So I think in the Singapore market, quite a number of things that are still going on. We're at the last week of the full year results season. We have also quite a number of different submission dates for the different SSB as well as T-bills. So do keep a lookout for these dates if you're an active investor, whether in the stock market or towards some of these government bonds.
Okay, so I think that's all the time that we have. I think next week we are looking at OCBC result, the final local bank to report. So if you would like us to cover that in our weekly market review, do drop us a comment below in the comment section below, and we'll pick those up and we'll try to feature those in our weekly market review as well. So thanks for the time today, and thanks for tuning to our weekly market review. We will see you same time, same place on next week on Monday in the next weekly market review session.
Thank you.